doable. Remember last time we covered theme 1 and theme 2? Just to reiterate a little bit, we're going to cover the last theme. So theme 2 covered the shrinkage, right? And these are questions that will come in your test, definitely. So pay attention to the themes learning unit so that at least from the very beginning you are clear as to the end goal, what actually we would like you to be acquainted with. So, and your themes are examinable. Your learning outcome, as you can see, so in theme 2 you will have 2 learning outcome. One of the learning outcome will be reducing shrinkage. I think this is quite easy, right? A quick read will make you clear what's all about, so that if you see question like this coming in your test, don't be surprised and think, well, but I was only supposed to focus on the calculation part. No, there are these learning outcomes that we would like you to achieve. At the end of the learning unit, you should be able to understand these learning outcomes, right? And these learning outcomes have been grouped in themes. So I trust that is very clear. So now back to you. Is there anything that you can share with regards to learning unit 2? Do you have specific questions before we move to our theme, our last theme?
I just say the ratios is quite a new thing.
Okay.
Um, but I think with more practice, I'll get more adjusted with it. Um,
Absolutely.
I'd say the beginning of learning unit 2 is a bit easier to tackle.
Yep.
Uh, from 2.5 to
Yeah.
2.7 in the learning unit, I'd say is the most challenging for me, but nothing that I'm lost in. So I think just with more practice, we'll be fine.
Wonderful. And thank you so much for that, Taylor. And actually, that's what I would expect from a top student. And guys, again, if you are getting hold of this recording, I have to say, if you are participating every single week, if you are doing your bits, it's just about doing your bits every single week. You won't be lost, you see. Um, and as you could see in in my communication with all of you, um, not saying I'm frustrated, but I'm just saying that, there is about half of the class that is not really engaging as much as I would love to, you see, and that will definitely be an issue as you move on, right? And I have tried my best to hold on a little bit, because the more we cover, the more you will be left behind if you have not been doing your bit every single week, right? So for all of you who might have not yet been on board, I know some of you were struggling with a couple of issues. I think I heard from some of you. I gave calls to some of you, and it was the registration, and you were waiting on the book, and only to find out that you had already access to portions of the book, and there's nothing that prevents you from starting. But just let me again reiterate something very important. Please go through your notifications. Some many questions that I'm getting is just I get the sense that you did not go through the notifications. So you might even be added today. I'm not too sure, because registration is definitely to a close. There might be some late rage, so it's possible. I've had students who've been added to the group late, that's a possibility. So if you are one of those late comers, right, just ensure you go again through the notifications in order for you to catch up. At least you know what's happening. And so going back to exactly to what Taylor said, I am 100% in agreement with her. It will require now that you should transition from the the theory part to the practical side, which is good because that's what should happen. And learning unit 2 should give you that opportunity to transition, to start. All right. So I was to touch to do maybe a 5 minutes for our assessment support because as you know, your assessment is on the 28th, right? I think I'm correct, right? So let me go again to,
So I think it's the 26th, if I'm not
oh,
Yeah,
sorry,
mistaken.
26, yeah.
apologies, my apologies. And I have people that are paying close attention. So it's definitely the 26th. As you can see, TBC would be to be confirmed. Then we will sort of know when your um, written exam. It's quite interesting that we will also have some, I don't know what unseen. Unseen is probably another way to say the written exam on campus, right? All right. So, but you have your task 1, which will be on the 26th of this month, right? Why do I need to do this? I have to do this because remember, we have to be very strategic, right? So 26 is about, you have less than 2 weeks. So you have 1 week, 1 week, and yeah, 1 week and 6 days. So close to 2 weeks, right? So again, as I was speaking to some of you, were like, oh, I will catch up. Don't worry. You know, yeah, I will do my bit. Don't worry. But I'm like, you're not gonna have the time if you have not started engaging with actually learning unit 2. You could definitely be at learning unit 2. And definitely the students who are here are definitely all of you, as I can see on this particular session, you are all up to date. So, but for anyone who is left behind, so if you are listening to this, just make sure that in these 2 weeks, you're going to be able to cover learning unit 1 and learning unit 2. I don't want you to do work close to the test itself, but make sure if you have not caught up, make sure you do that. Make sure you catch up now. All right. So that was just a quick intro. But again, um, any of you check again our PAS? Have we had some updates? As soon as there's update, I will definitely update this PAS, the snapshot of the PAS. But anyone who check the PAS, did they put the date for the exam? Because I see unseen exam sitting 1 will be your written exam on campus. We need a date here, but for what matters at the moment, let's focus on this. All right, so we have our task 1, as you can see, on the 26th of March. You have 2 weeks, right? Okay, so that's it. Let me go back again to our third part here. That's what we were busy with. And we, as Taylor mentioned, we were touching on, just a second, just give me a second to have everything. All right, should be good to go. I don't know why the selection here. All right, okay, so the analysis and interpretation. All right. Everything's fine. Right. So analysis and interpretation of financial statement. Just like Taylor mentioned, that's where you start to have a little bit of I can't say difficulty, but I would say that's where you understand that now, even though you read and you understand, it is not enough if you do not practice. And I don't know why students sometimes do struggle with this notion, because this is a numeracy module, it's not a theory module. All right. So you can definitely understand something by reading it. But if you are not doing exercises, you'll quickly forget. You would definitely quickly forget. So it would be redundant, actually, to go through this and to understand, like, I understand the ratio. You read it and you understood. So if I ask you a question, I say, did you go through learning unit 2? Do you understand? You would say, yes, I understood. But the thing is, you put practice aside, you're like, but I'm going to practice later. And then you find yourself doing double work. And this is actually a good tip, because that's what it's going to be about for the rest of the semester. It's about us, not only your lecturer sharing tips with you, but also you sharing tips between yourself. And as you can see, I did even share tips from one of our past student, top student, Easy. She also shares some tips. It's about that. It's about understanding that you will be doing the work over and over again, because you will read and understand, but um you won't be able. So let me just check in our chat. Is there something that came through? Absolutely. Absolutely. Actually, there is even a difference between understanding and what we call actually application or wisdom. One has to put it that way, but it's all about that. So you can understand, like, I rate this ratio, and that's what I would like. I don't want to do, is basically going one by one. You see, we covered some of the ratios, but we're just going to brush through them quickly, just to make sure that we are on the same page before we move to the last part, right? We still have a bit of time. If I check, we still have a little bit of time, right? But you have your solvency ratio. Obviously, by reading, you understand quickly that this is as simple as it measures the ability of the entity to settle all its liability. So we understand clearly that our assets must be greater than our liabilities, right? Why? That's the meaning of being solvent. So in case right now we have to basically, the business is no longer, actually, we have to close shop, right? The business is no longer working, or we are divesting, or whatever it is, right? We would have some liabilities, and we should have enough assets, to cover those liabilities. So when we're running a business, so that's where the ratio is important, because whoever looks at these ratios needs to be able to see that the business is solvent, and that's a positive thing. you know it is a positive thing. It is the interpretation part. The reason why you read and made some note is for you to be able to interpret it. So for example, when we're doing a quick calculation, you're just basically going to take your total asset divided by your total liability. Now, be careful, don't give me an average here. As you can see, there's no average. You are dealing with two items from your balance sheet, right? You are looking at your total asset and also at your total liabilities, right? And it is as simple as divide them to get a ratio. It's basically this versus this. So for my assets, what is my liability? So it's the ratio is best way to compare the two, right? So that's for your solvency. Your profitability, like we talked about last week, not gonna linger longer here, but as you remember, you have your gross profit, um, as well as your net profit. Yes, you know how to make the difference between these two, right? We covered our income statement, right? So we are dealing here with two items from your income statement. So whatever income statement they give you, it does not matter. First of all, if they give you a statement, it does not mean you should panic. Statement for you should be something that allow you to see what's going on, right? So you're not just going to look at a statement and it gives you a quick picture, right? That's why you use these ratios to make it even more clear to you what is actually going on, right? Remember again, analysis and interpretation, financial statement. So you could analyze, you could do the calculation, but you are not interpreting it right. So that's where basically your theory and your practice now come and marry each other. It's a perfect union. All right. Okay, so we have our gross profit, as simple as that. Remember, we are looking at a percentage. That's why sometimes it could be referred to as a gross profit margin or percentage. These are the same thing, the same principle. You should not panic, right? You take your gross profit, you divide it by your total sales, right? Multiply by 100. The multiplication by 100 gives you the percentage. Percent per 100, per 100. Right. Cool. All right. So net profit, same principle. Easy. Anybody start struggling with simple calculus? All right. So another thing will be your return. You hear this quite often. ROE. You will see it quite often if you've come across some financial analysis. You will hear ROE. So this is basically your ROE, your return on equity. And this is a big thing, right? Because who are your equity holders? These are your shareholders, right? And by shareholders, what words comes to your mind? What type of investment comes to your mind in our chat there? Because remember last time we were talking about our shareholders. When you see shareholders, obviously, what do you see by that? That's your that equity capital, right? So these are bringing actually investment, but their investment is equity, right? It's not debt. Remember last time we talked about this. If you missed it out, go back to our recording, right? But when you look at them, you will see in terms of capital, these will be your equity. And that's the reason why we call them owner's equity. Do you see? Owner's equity. So the capital that they're bringing is because they're owning the company, right? Their type of investment is to have an ownership. That's why we talk in terms of shares. They hold shares in the company. They hold they hold a portion of the company, right? So when you're reading this, if you have this kind of understanding, then you can never struggle. So then finance becomes quite clear because this should not be something you memorize. Like I said, I'll keep on repeating this, but please, if you are memorizing sections of the textbook, you are studying wrong. And you should not be ashamed of saying, wait a minute, there's also a good thing about unlearning and learning. So if you are learning the wrong way, unlearn and learn it the right way, right? So this module, like I've been saying, is the kind of module you don't memorize. So don't memorize. I know you will tell me, guys, you will tell me about the formulas, but I'm saying to you, once you understand, and that's the reason why we should engage. Ask me questions, how best to understand this. And maybe it's just if we break it down easily, then you can easily remember. And the formulas, trust me, I've never had to memorize a formula really. I can forget a formula, but once I look at it, especially when I do the revision, once I just look at the formula, I'll be able to remember quickly because I know what it's all about, right? There was a hand there. Was it Taylor? Taylor, do you have a question?
Yeah, sorry, sir.
Yeah,
You
no
you
problem.
answered the question for me now. I was going to ask if we have a formula sheet and if we need to memorize the actual formulas.
Absolutely, absolutely. How is it that I know how my students think, because look, if you've lectured for as long as I've done, you kind of anticipate all the questions. But yes, and that's the reason why I even shared with you guys one of the tips with Easy is that you could put all the formulas on a particular sheet. So you have all those formulas in on one sheet, but it's not actually for you to memorize the formula. It's just for you to remember the formula, right? But it's again comes to the fact parts where when you are studying this, look at the formula, understand why we are doing the formula, because otherwise it won't help you. So when you're looking, for example, at a return on average, what kind of ratio is this? It is a profitability ratio. So you are looking to see how profitable. And that's why basically it's always about, for example, when we look at the gross profit, we are looking at the ability of the company to generate profits. As simple as that. Are we able to sell product? Why? Because what is gross profit? Always start there. What is gross profit? Don't just say, okay, let me memorize gross profit divided by total sales. You see, I would say that's the wrong way to study. The best way to study is to say, oh, gross profit. How do I get the gross profit? It's revenue minus my cost of sales. Again, remember, even in the middle of the night, you need to know your statement. You need to know the flow in your statement. Guys, I'm not saying all statement will be the same, but they will have the same principle. It will always be like for your income statement, you are minusing a series of incomes, and you're adding a series of income, and you are removing a series of expenses, right? That's the easiest way to define, right? The statement of comprehensive income. But you have your revenues. And for me, it's already those two items in my income statement. Okay? My revenue minus my cost of sales. Just a second. Not too sure why my, sorry about that. So something is not working. Yeah, but like I said, remember, just keep that in mind. Okay? Revenue, the two first items of your income statement. Revenue. Are you all on the same page with me? Let me just check with you. Are we on the same page? Revenue minus cost of sales. You okay? Thank you, Taylor. Anybody else? Revenue minus cost of sales. Thank you, Isabella. Thank you, Connor. Thank you. I just need to check because sometimes I'm not too sure, right? Okay, so in that case, gross profit margin or percentage, I know it's basically once I get my revenue minus my cost of sales, I will get my gross profit. And I just divide it by the initial revenue, the initial sales to see this gross profit, what percentage of the total sales. That's what it's saying. This formula means the profit that you have from minusing total sales minus cost of sales, the profit that you get, what percentage of the total sales is it? Okay. I think that's the best way I can put it, right? Especially when you are interpreting, you just need to see, because remember, we are selling product, but are we selling product cost effectively? Are we selling in the most basic of terms? Are we selling products well? Are we doing it well? Are we good at that? All right. Okay. So net profit, the same principle, right? How, but now you have to add other costs. Remember that after the main cost of the cost of sales, right? We have a series of other costs, right? We have the overhead that we need to minus, right? So we gotta be very, very clear on that. So, but now you are taking into account how effectively a company manages its cost in order to generate actual profit after I have deducted all form of costs, okay, including the interest and the tax. Just thumbs up again. Is that clear? All right. And the final one, just to be more precise. Obviously, ratios, we can have multiple ratios out there, but just see what the purpose of the ratio is. What is it that we're trying to measure? Because we are measuring something, all right? So the return on average owner's equity, it's said there average. So obviously you're going to be taking an item that is coming from your income statement, your net profit, with an item that is coming from your balance sheet, right? So check there, the average. If you have 2 years, they give you two years. Let's say you are talking about 2024, but they gave you also the 2023 the balance of 2023 or what it was at the end of 2023, then you understand that you need to average. And the average, as you know, is the previous equity plus the current equity divided by 2, average divided by 2. Trust all of you get that, right? But for what it's worth, we are looking at the actual net income or profit for what our shareholders put in. This is a very important ratio. And I know many companies check this ratio closely. And imagine just you are an investor into this company, especially as a shareholders, because you are coming into the ownership of the company. Would you think that this ratio is not important? It's quite important, especially if you are comparing a couple of companies to see which one you should invest in. Oh, oh, if this return on owner's equity is higher, it could give me a good indication that I this company is definitely profitable, isn't it? But it is a profitability ratio. So I'll be able to compare several companies and say this one seems to me to be more profitable than the others. Liquidity ratio, I'll flow now quickly, right? Same thing, there's a formula, but understand the formula. What are we trying to do? Liquidity, what does it mean actually when we say, is the company liquid? Does it have cash to settle short-term debt? Because remember, our short-term debt, uh, especially when we're gonna go to learning unit 3, it's gonna flow perfectly because there we will be talking about the net working capital, right? There is something that allows us to do business on a day-to-day basis, right? If you are a retail company, obviously you are buying or your suppliers, are giving you merchandise on credit. That's a debt that you need to repay, and you repay by selling, obviously, that merchandise and getting some profit. But once you sell, you need to return, right, what you borrowed, right? So the current asset and the current liability, and that's where we talk about the net working capital. What is really grinding? What is really the actual engine that generates the revenues? So tell me, it's not a one-man show. To stop here again, check with you. Guys, is this making sense? Remember, right now we are just giving you a broad picture. So you don't need to be actually super, super well versed in all this. No, no, no. Listen, we are just having a picture. So if you, I'm sure all of you get this, right? Any business out there, this is the way any business function, right? But remember again, the purpose here is to settle those short-term liability, but we can make it even more precise. We can do even a better test, a better test, which is the acid test, where we remove actually the inventory to just make sure how much cash liquid is there, right? That can allow us to settle our current liabilities, right? Current liabilities. Very important. So asset management ratios, very important. Very, very important. Because you are trading. Any company out there, guys, remember again, it's about, I don't know too many companies that don't require any credit. The best way I can put it, it is not very realistic. That's not really real world, right? Uh, um, so with regard to the timeline, you have obligations as a company. You yourself, as a person, have obligations on a monthly basis. You have to settle bills. Some of you are purely student, maybe might say, that's not really my world. I agree with you. But look, if you are definitely a functioning um, entity, very important, you are working. You see, as a person, you need even to make a distinction between the you, the physical you, and the you that is a financial entity. You work, you earn revenues, you have an income statement that you do not know. Maybe because you don't put it on a paper, but that does not mean you do not have an income statement, right? Guess what? Ask your bank. That's the reason why everywhere we go, they ask us for banking statement. Can you provide us your banking statement? Your banking statement is a income statement, right? It's quite a telling income statement because we can see through it what you're spending your money on and all that. But again, guys, this is where we come back again to the world of credit. There will be certain things that we are buying, we are purchasing on credit, and things that we are selling on credit, right? What we are selling on credit, meaning that they owe us money, right? So that's credit sales. What we purchase on credit is what we owe, right? As simple as that. So, but this is asset. Yes, it is asset. What kind of asset is that? In our chat, what kind of asset? Guys, I'm making this very realistic. What kind of asset? When we talk about this asset management, what kind of asset? Yeah, especially when we touch on these two, average debtors collection period, as well as average creditor settlement period. Guys, trade debtors. That's on your balance sheet. That's your that what is this? Trade debtors. That's your current asset. That's your current asset. Are we on the same page? Oh, I'm so scared. So it's hopefully quiet. Are you there, guys? That's your current asset. Remember your balance sheet. Always have your balance sheet. And that's the reason why, knowing that some of you might struggle to, I again give you asset, equity, liability. Asset, equity, liability. All right? So your asset is divided by your current asset, which is your short-term asset, and your non-current asset. Current, current happening now, short-term, short-term, non-current, not short-term, longer period. Is that clear? Perfect. Taylor is good. Anyone else? Isabella. All right. If you have a question here, please stop me. If already this part is getting too complicated for you, we need to talk about this. All right. Remember again, the average, very important. You are dealing with items that are coming from the balance sheet, and the formula says it there. Average inventory turnover. And it's important to see the average there, right? So when you have remember for your datas, we always need to talk about period, data collection period. Because why period? And that's why it becomes very, very important. Is like you have obligations. Obligations means a period of time. You know, you can't have a debt that you will repay whenever you want. There need to be a timeline where you are repaying this. Yeah, yeah. Nafisa, your comments there, on point. So first thing that comes to mind is you saying that equipment is an asset, not an expense. Yeah. Why would you think that an equipment is an expense? It's an asset that you have within the company. So Nafisa, to make it easy for you, an equipment generates money for us. An expense doesn't generate money for us. Now, is everybody clear? Is anyone would say that they don't understand this? An equipment, an asset is what allows us actually to generate that revenue, that income, right? So let's talk maybe about a manufacturing company. You have equipment in that manufacturing company, and that equipment is producing, let's say, maybe plastic, right? That equipment is what generates revenue. An expense could be maybe paying the rent, the yearly rent. When we pay rent, do we generate revenue by paying rent? When we pay our bills or the telephone bill for the company, do we generate revenue by simply paying rain for the internet? Obviously, these things are important to do business, but they don't actually. So, is it not true to say that equipment is an asset because it can be sold for an income? No, 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 no. Your equipment cannot be sold for an income corner unless you want to settle basically a debt, like the company is going bankrupt, you have to sell equipment. So if you are selling your equipment to generate an income, I get what you're saying. It's going to generate money coming in the company, but not generating an income. Your income or your revenue is actually what you're selling on a day-to-day basis to allow you to do the business that you are doing. Okay, good example would be, okay, no, yeah, actually I was on the same page as you. I think that's what you mean. It's gonna generate an inflow of cash if we are selling an equipment. But again, you can't sell. It's not good practice. Listen to this, everyone. It's not good practice to sell long-term assets such as equipment to settle short-term debt. Very, very bad practice. Very bad practice. And that's why, by the way, we are doing asset management, because short-term assets should be able to deal with short-term liability. Does that make sense? So imagine I have debts. If I have those debts, and those debts are long-term debts, and I cannot pay those long-term debts, then I know I'm in trouble. So basically the bank, this time it's not even going to be a choice. You don't just make a choice and say, let's generate some assets, let's sell some assets, in order to settle our short-term debt. Some companies could do that maybe if they are moving, shifting their business into another business. All right? I'm giving you real life examples. So guys, please pay attention. This is not the part where you sleep. All right? So imagine a company that says, okay, we were manufacturing shoes, but right now we are moving into another kind of business. So that equipment for shoes will no longer be needed. You see, then maybe the company in that case can say, listen, we don't need this equipment. We can sell it and get money into the company. But remember, these are long-term assets. These equipment are very expensive. Every equipment that allows you to do your business, it's quite a lot of cash investment that went into buying that equipment. So basically, you're not gonna take that money. You can settle debts. Yes, you can choose. Most of the time, a company maybe will retain that big income to say, let's use this massive inflow of cash. So let's not say income corner. Let's use this massive inflow of cash. We can maybe retain it and use it to buy new equipment. Right? We can sell old equipment to buy new equipment. Guys, do you see? Please picture, if you get this, finance is few principles and you starting to get everything right. Okay? So, but now, what we would not do is to sell long-term asset to be settling short-term debt, because short-term debt should be settled by the activities, by the normal income we are generating in the company from our actual business. So like I said, if you are in a retail business, you are selling, let's say maybe clothing, right? The sales of clothing generate an income, and that income should be sufficient. Portion of that income should be sufficient for you to settle short-term debt. But if, for example, you are insolvent, the bank that loaned you money say, listen, you are no longer able to pay. And this happens not only to a business, but it also happens to you. If you take a car on credit, the bank loans you money to buy that car. Okay, I'm just going to make it quite easy, right? Bank loans you money, and then you are not able to pay your monthly obligations. The bank will say, listen, we will need to repossess that car. We will need to repossess that house. Remember, a house, long-term asset. A house is your long-term asset. Uh, uh, car is medium-term asset, right? Normally 5 years, depending on how you're financing. Listen, I don't want to get into your business, but this is just a way for you to understand what's going on here. But the bank can say, listen, you're not able to meet your monthly obligations. We're going to repossess the car and we're going to sell the car. So they're selling an asset in order to be able to recover a long-term loan they gave you. They're not going to say, so coming back to Nafisa, we're not going to say, well, I can't even pay my rent or my groceries. I'm going to sell my car so that I can pay my rent and groceries. So your expenses, your asset will be your car, right? Just like an equipment, right? But your groceries are expenses. Your rent is an expense. Does that make sense to you? When you pay your rent, do you generate an income? Yeah, good question, right? It's just an obligation, you know? These are the minimums for you. Okay, guys, I stayed quite a lot here, but I think this was a good question, huh? Right? Nafisa, if you can unmute yourself. I'm not too sure when you say unfortunately not too sure. What is it? Not too sure you're gonna sell your long-term assets to settle short-term. I hope that's what you're saying, right? Okay, so cost of sales divided by your average inventory. We want to see the inventory turnover. Look very well here. You are looking at multiples. How many times do we turn over the inventory? Because remember, the inventory, we will be buying merchandise or our stock, right? And we sell it. So we want to find out how many times do you do that? Is that making sense? How many times do you do that within a year, a business year? So let's say you do that 12 times. Yes, absolutely, Nafisa. So we are in agreement. We are in agreement. So Nafisa, that was a good way. It's a good question. Let me be clear. Your question is very valid because yes, unfortunately, if you will make um an error in wrongly categorizing an item on your balance sheet, it could cost you a lot of marks, right? But as we practice, Nafisa, this is going to be very clear to you, right? Asset and expenses, these are not even synonymous, not at all. Uh, where are we? Okay, so guys, the last part here that I wanted to touch on was this: investing in shares. We do have a recording. I'm going to paste it even here in our chat here. It's already on our Teams. So please go through this recording if you have not done so. If you've done so, this is quite well summarized, right? What I would like to touch on, basically, so in the recording, I covered this technical and fundamental analysis. You just need to understand it, right? Please just go through it. It's there. But I want to touch on the gearing and investment ratios, if you would allow me, all right? Remember, we covered the profitability ratio, the liquidity ratio. Profitability and liquidity, by the way, they remember we even cover solvency ratio, right? So there could be many ratios out there. Look, there could be, as long as you understand what's the purpose, what are we measuring? What are we measuring? What are we trying to measure, right? But the four main ratios everywhere. The first one will be profitability, just like we said. Okay. Investors out there, they are looking to see, and it's a no-brainer, guys. It's a no-brainer. Be the person who is looking at companies, but he doesn't care if a company is profitable or not. Profitability, that's the first term out there. You know, when you are running a business for profit, not a non-for-profit organization is something different, right? But a profit, a for-profit organization or business, profitability profitability ratio is one of the key ratios, right? Profitability ratios, liquidity. Is the company liquid, right? We can touch into solvency. Is it solvent? That's also good, but liquidity is very, very important, right? Are we able to meet our obligations? Gearing ratios, that's where it becomes very important, especially when we're touching on investments, right? And then we have the investment ratio. So we're just going to cover these two quickly and we move on, right? But so for your gearing, we have to look at the extent to which a business is leveraged. how much debt did we take to run this business, right? And then the investment ratios, obviously. So this will cover the gearing. Now, guys, see how easy this is. Gearing will cover the debt equity. Remember, we have equity. That equity can come from two sources, either from the owners' own money. So you can say, but what if the owners never took money from people? Yeah, but he put his own money. So that's the owner's money, right? Okay. So the gearing will cover more the debt equity, what we borrowed, right? And the investment, like it said, it is investment, right? Okay, so two of them are the debt to equity ratio. Very important. And you just need to remember non-current liability, because we are not looking at that short term, that small credit you are taking from your your supplier. So I don't know any one of you who's running maybe a retail right now. I'm not too sure, or a restaurant, right? It doesn't matter. But you have people who are supplying you. We're not talking about that. But if you are, for example, a restaurant, you have equipment there. Nafisa, equipment, which is your asset, which is your long-term asset. You see, I mean, if you have a restaurant, you have kitchen, you know, unique stoves and all that. These are very expensive, right? Very, very expensive. In order for you to be able to cook and to give people meals, and they pay you for the meals, right? This is not about this short-term stock of carrots that you need to buy for your restaurant. But trust this is clear. This is another example. So whatever business you can throw at me, I can tell you what is non-current, what is current, right? So non-current liabilities divided by the total equity. Sorry, a little bit, it's total equity. So forgive my handwriting, but I just want to emphasize this. It's non-current. That's all. The total gearing now will be the non-current divided by the equity plus the long-term liability plus the non-current liability. Now I'm asking you, why is that? It is there in your notes. It's clear because we want to look at the total capital employed. The total capital employed meaning that not only from the equity side, but also from the debt. Not only so not only from uh, 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 um, the capital that came from our shareholders, but we are also looking at our long-term liabilities. All right, debts that we took, high-stake debts, bonds. You know, when you are financing for your house, you yourself, when you are financing for a house, you take a bond, which is a long-term liability instrument. Bond. Is that clear? Companies also use bonds. Okay, guys? All good? Yes. And by the way, yes, guys, yeah, I know, I'm sure you all know, right? Companies use bonds. If you want to finance a new plant for the manufacturing of something, you take a bond because this is long term, right? So you take that. So all the capital that was employed from the shareholding capital to the debt capital, all right, from the equity capital to the debt capital, all this capital. Equity and debt is capital. Equity and debt is capital. So don't confuse equity with capital. Don't say equity is capital. No, equity is not capital, right? It is a capital, but it's not the only capital. So my bad. Again, I'm saying capital can be debt. Anything that is long-term debt, right, is a capital, but it's a debt capital. It's a debt financing capital. The capital is what you are using to run the business, right? So total equity employed, that's the reason why we are using this, because what we want to find out, how much percentage is the debt for all the capital that was employed. Ratio or percentage, same thing there. Debt versus the total capital. And this one, it's very specific. This is debt to equity. Debt to equity, right? Debt versus equity. Are you having a 60% debt capital? Right? Okay, just clear. And this one, this is the best part. It's very simple. It flows. If you have questions, the exercise of this have never been a problem unless somebody just did not understand. APS, we're taking earnings attributable to shareholders. Earnings attributable to shareholders. So when we have our net profit, if they only give you the net profit, remember the last one, the net profit after you have deducted all the cost and expenses, right? The last one. You must check if so your earning attributable to ordinary shareholders is in many cases your net profit, right? But you just need to divide it by the number of ordinary shares that are issued. Simple. We have 1,000 shares that we sent out there. So we take our earnings attributable to ordinary shares, we divide it by the number of 1,000 shares. It gives us per share. Okay? Per share. Earnings per share. The same year, a quick example, you will have a 10 million shares that have been issued, and we are making a 4 million rand in net income. Do you see it? Quick example, 4 million. So then we would divide the 4 million by 10 million. Gives us 0.4. 0.4 rand per share. Is that clear? This is not, it's very good when you are looking at one company. But let's say you are comparing different companies in different industries. You will need a better tool because not all companies have the same number of shares out there, right? One company can be bigger than another, right? So it's not really the best tool. That's why we can use the price earning ratio. Price to earning ratio almost like put all companies on the same footing. But it's a way, remember the price, that's the reason why we're looking at the stock price. Is the stock price going up or the stock price going down? Is that clear, guys? If you read this and everything was clear, just a thumb up. So that's your PE. You take your market price divided by your earning per share, this one. That's a very good way to compare different companies out there. Is that clear? Perfect, perfect. And you have examples here. What I want to hear from you, what worries me is if you have any issue and you tried this example and you didn't get it right, why didn't you ask me? Why didn't you bring this up, right? So just make sure again, I'm telling you, it's very simple. It's a quick calculus, but you need to understand the purpose of it, right? Because the PE measures the investor's confidence in a company, all right? Because when you're looking at the market price, that's what investors all the time are looking. You will see many of you who are investing in stocks or if people who are investing in stocks, they're always looking at the market. Oh, the price went up. Oh, the price went down. You see, because the price actually captures quite a lot, you know. And our technical analysts actually, if you check the two, the fundamental analyst and the technical analyst look very much also at the share price, the fluctuation in share price, right? Okay, so but it's quite clear there. The PE ratio is useful in comparing the relative values placed on the earnings of different companies. These companies are earning, but we want to find out, we want to compare relative to other companies. So in comparing the values placed on companies' shares in relations to the overall market, so it is a very good indicator of how a company is performing. Is this company performing well? Does it have investors' confidence or not? All right. Are investors willing to pay? See again what I'm showing you. Very important here. Are they willing to pay for each rand that a company is earning? How much are they willing to pay? So if we look at this quick example here, we can see that company A is willing to pay 50 rand for the earnings of the company. Company B is willing to pay 40 rand for 1 rand of earnings per share. Is that not interesting? So that's why they look at this company, they're like, wait a minute, why is the PE very high? Why are the investors really confident that this company, why are they paying so much for the shares of this company? All right. Is that clear, guys? Okay, I will leave you with the rest three, very easy, very important again, but I want you actually first to start a discussion with me in our chat, or if there's something that you struggle, but this is just quite easy, right? So we have the dividend yield. We take the annual ordinary dividend per share divided by the current share price. Remember, it's a yield. It is a percentage. Yeah, it is a yield. Remember the dividend? Last question to you guys. What is the dividend? Why are we talking about this? Because now you will tell me, what are we wasting our time? What is this dividend? What is the dividend? It's not the earning per share. It is the actual money that we pay out, right? So remember, last week we talked about one part of the profit will be retained, one part of the net profit will be retained to invest in the company, right? And one part can be paid out as a dividend. So when we're looking at the dividend payout ratio, this is quite interesting. We would like to see what is the percentage that was paid out to the shareholders. So dividend per share, very important. Dividend per share divided by the earning per share. Absolutely. Absolutely. So not only we call them to the shareholders, right? To the ordinary shareholders. Yes, absolutely, Taylor. So the dividend is what we pay out. But now why do we do a dividend payout ratio? The dividend payout ratio is to see the percentage of money that was paid out to the investors. Does that now make sense to all of you guys? So if we found out that the dividend yield, the dividend payout ratio is 40%, automatically we know how much was retained. 100 minus 40. So we know 60%. 60%, 100%, right? So the earning per share is basically represent 100%, right? Part of it we paid out to the investors. So that's a percentage. What is the other percentage that was retained? That's what they want you to be able to understand. That's the beauty. Quickly, with a quick calculation like this, you can tell us, okay, the dividend payout ratio is 30%, so 60% was retained. Correct. And how did you get it? By just doing a simple calculation. Dividend per share divided by earning per share. Is that clear, guys? We are wrapping up. Is that clear, guys? So Taylor get it perfectly. Esther gets it. Connor, thank God. So, oh, guys, some of you are getting. Sidiran, I'm worried. Nafisa, I'm worried. It, so, but guys, I'm going to stop the recording here. But if you want to stay, you want to stay and ask uh, further more questions, I'm available, right? But I'm just going to stop the recording, and if you would like to, you are free to